In this episode, we talk about how to value an early stage startup, how much equity to give up in a funding round, and the challenges of early stage startup valuation.
Learn more about the do's and don'ts in venture capital.
Welcome to episode 6 of this podcast series, Venture Capital Deep Dive. In this podcast, we talk about everything a first-time founder needs to know about the why of a venture capital investor. This podcast is brought to you by B2V Ventures, a Switzerland-based venture capital fund established in 2000 and focused on early-stage startup investing. And I am Cédric Bollock, your host of this podcast and the founder of GlobalTechBooks.com, a video platform focused on insightful interviews with experts around startups, tech, and innovation. Make sure to check them both out. Alexander Stoeckel is a partner at B2V since 2012, board member since 2014, and is actively seeking the best entrepreneurs and most promising startups. You can reach him over LinkedIn and email. In today's podcast, we talk about valuation, and valuation is one of the key topics whenever you have to make an investment in an early stage company. So maybe first, just give us a short rundown on how you value a company at this stage.
Valuation, everybody will tell you, it's a complex topic and there's no precise way to calculate the valuation of a given startup. So what you're doing really is mapping the progress that this company has made so far against the financial strategy that they're using to raise capital right now and in future rounds of funding, and see that you get to a shareholding in the company that fits your investment strategy as investor.
Okay, but what are, let's say, some of the multiples that you're looking at? I mean, when you're looking at stocks and bonds and all of the traditional investments, even real estate, you have very fixed multiples and things you can look at. An early stage, it's a different story. What is the story there?
When you have an established company, you can look at multiples on revenue, multiples on EBIT or EBITDA. You can put price tags on the number of users that they generated with the platform. With startups, it's more complicated. First of all, many of the startups we're looking at do not generate significant revenues. Most of them are not profitable at the moment, and even the user growth rate is not tremendous by itself. So what you really do is you try to validate whether or not the startup is actually on a growth path, and you're trying to project this into the future and think about future rounds of funding and an eventual exit. And then again, get this down to today and think about, what am I investing today? What sort of share do I get in the company? How will that play out in future rounds of funding? And what will be my stake in the company once it's exited to, let's say, another company as part of a trade sale?
In one of the previous episodes, we talked about the term sheet and how it affects the valuation, especially when you anchor. Maybe you can establish a little bit again, what this connection is for people who are just tuning in for this episode.
Let me first briefly talk about the concept of valuation. So what you're looking at in terms of the mechanics is the following. Let's say you're an entrepreneur and you're raising 500,000 for your startup. You're looking at a pre-money valuation of 1 million and a post-money valuation of 1,500,000 because you're raising 500,000 in this present round of funding. The investor would get, as a compensation for his investment of 500,000, a share of 33% in the company, because 500,000 in relation to the 1.5 million post-money is exactly 33.3% share in the company. Now, the interesting thing is, if the entrepreneur feels that he can negotiate a valuation of, let's say, 2 million, and again ask for 500,000 investment, looking at a post-money valuation of 2,500,000, then the share of his company that he would give away as a compensation to the investor would be only 20%, because 500,000 in relation to 2.5 million is exactly 20%. So this indicates that the negotiation efforts of investors will always be targeted at driving down the valuation, because then the share in the company that I can get for a given investment is slightly bigger. And it also determines that the incentive for the entrepreneur will always be to up-negotiate the valuation, because the higher the valuation, the lower the share that you have to give away to the investor as a compensation for the investment. Now, this game is not only driven by the valuation itself, but also sheds a light on the other clauses in the term sheet, because clauses such as liquidation preference, for example, will often correspond with the valuation that the founder is asking for and the investor is ready to pay, because liquidation preference determines that in case of a not so positive exit of the startup, the investor can claim at least a preferred payback of his initial investment in the company.
When you look, let's say, from an entrepreneur perspective, and I come into, let's say, this negotiation about the valuation itself, what are, let's say, the big advantages and disadvantages of having a high or low valuation? I mean, as a founder, I want to have a very high valuation. I would say long-term for investor, it's the same goal. Just want to come in at a cheaper price. But in general, like, what would you say are the long-term effects of the valuation? Let's say when you look at the whole life cycle of a startup and not just like the initial seed stage or Series A investing.
Let's say you start with a very high valuation. Let's say you go out for the seed round and trying to raise 500,000, but you feel that you should raise based on a pre-money valuation of, let's say, 10 million or something. And let's assume that you even find somebody who's willing to invest at that valuation in your company. Then this might feel like a victory because you found somebody and the dilution of your shareholding is very small. However, in the next round, you may find that this is in fact a burden, because in venture capital, the narrative of your company should always be that the valuations have been growing ever since. So the next valuation will be something on the order of 15 million, maybe 20 million. But the problem is then that now, 2 years down the road, you have much more traction in the company, and it'll be harder to justify the valuation if the performance is not where it should be to ask for a 20 million valuation. So therefore, be cautious when you negotiate for too high valuations, because they may drop on your feet in future rounds of funding. If you then consider going after very low valuations, this may sound more appealing to the investor at first glance. However, the dilution of the founders in a low valuation is significantly higher. So therefore, the share that the founders retain is lower, and in future rounds of funding, they may even risk to drop below the 50% majority shareholding. So therefore, if it's too low a valuation, it's not only hard to get to the next higher valuation, because there will be significant jumps from 1 to 10, that also has to be justified, but also you risk to be diluted too much and then eventually drop under the 50% minority shareholding. The other thing that entrepreneurs should bear in mind is the amount of money you're asking for should also correspond with your financing strategy, meaning your funding round should enable you to go at least 12 or 18 months. Otherwise, it will be difficult for you to get the company to a different level, let's say qualification for a Series A round. And if you don't have enough room to maneuver and get the company performance-wise to that level, you will have a hard time raising money in the Series A round. So therefore, if you consider taking a low ticket, for example, which may also sound appealing to certain investors out there in the market, you might again shoot yourself in the foot because you don't have enough liquidity to take the company to the next level.
Now, I mean, you have done a lot of investments and you've been in a lot of these negotiations and meetings. And maybe you can elaborate a little bit on, let's say, the atmosphere that is going on, specifically on who is the one that is actually going to say the first number? Is it the entrepreneur that has to be reasonable about the first valuation, or is it more like the investor that gives kind of a price tag, this is what I'm willing to pay?
So usually there's a number on the table that has been proposed either by the investor or by the founder as part of the initial term sheet negotiation process. So via email, term sheet gets submitted either by the founders to the investors or by the investors to the founders. And then that's the basis of the discussion, which is why in the previous episode I was referring to the advantage of giving out the term sheet from the founder's side, because then you can maybe anchor the valuation discussion around a certain value that you feel most comfortable with. During these meetings, it's an exchange of arguments, but it's not a lengthy discussion really. So usually you will say things like, this valuation that you are asking for example, does not fit our investment strategy because we always strive to have double-digit shareholdings in companies. So with your valuation and the ticket that you have proposed to us, we only get to, 5%, 7%. That's no fit with our investment strategy. You cannot do it, for example. And then the founder may say, okay, to accommodate you, we can think about like you get 10%, you get 15%, whatever it is. That would be relatively easy. You can also try and argue that argument that the founder is making for his valuation is somewhat flawed. So maybe he argues that the number of users indicates that if you put a price tag on every user, that your valuation should be this and that, for example. And then you can argue that, in fact, this price tag is somewhat virtual because it's not yet really shown that the user has a value of XYZ. Therefore, this cannot be taken as an argument. So what you do as a VC to prepare for these negotiations is really to come up with a corridor in your mind that you feel comfortable with. So there's a lower end where the valuation is too low and the dilution of the founders is too extreme, and you shy away from that, and that's not an option. And there's also a valuation that's too high, both in terms of the share of that you get as an investor is too small, and the burden on the company itself will be too much for the next round of funding. And in between, there's something you feel more comfortable with. And then you can maybe juggle the valuation, with other clauses and terms that you can put down in the term sheet.
B2B is very much focused on, let's say, seed and Series A investments. Maybe you can give like some idea of best practice. How much equity should you give up as an entrepreneur? What is a fair valuation? And again, it's a very holistic approach. It's not something that like you can say like case specific. It can be totally different for any case. But like, what is, let's say, the upper and the lower limits that you would say like that is something that is reasonable for an entrepreneur to give up in an early stage for a certain amount of money?
Yeah, so I think in early stage you're looking at targeted shareholdings for the investors, something on the order of 10 to 30%, really depending. On some rare cases, you might be willing to give away even more because the investor brings significant value to the table. Like he can open the door to double-digit million amounts of revenue, etc. But generally speaking, 10 to 30% sounds reasonable. And also think about the number of future rounds of funding that you're going to raise, again, in terms of dilution and where you want to end up as a founder. And also think a bit about where the investor ends up. You have to realize that the VCs, generally speaking, will always try to invest in companies where they have the potential to make at least times 10 on their initial investment. As a return on investment. So therefore, the investor is also thinking about, if I'm investing right now, let's say at a 10 million valuation, this company has to be sold for at least 100 million. How many deals in Europe do we have on average per year that are sold for more than 100 million? Not so many. So is this most likely the outcome that I'm going to see in this case here? Maybe not, depending. So do I feel comfortable with this valuation, or should I maybe try a bit harder to get this down to, let's say, 5 million, for example, where I feel more comfortable? So, and if you as the entrepreneur has a good understanding of what you want to achieve and also what the goal will be of the investor, and try to think a little bit about this payback that he hopes to gain from the investment, you will be in a good position to negotiate and argue fairly your valuation of the deal.
When you look at, let's say, the entrepreneur perspective, and they say like, well, I really believe that the company that I'm trying to sell you an equity stake is worth more than what you're thinking. What are, let's say, the best arguments you would say, justified arguments, not like out of the blue arguments, like justified arguments that you would say like, yes, you're right, during the due diligence, I didn't see that. Like, yes, that is an argument that I would say that is justified to get a higher valuation.
Well, if you can show that every euro that we put in the company is basically generating returns of 3 euro, if you will. Basically speaking, that'll give you a lot of room to argue for your valuation, because you can say the more you put in, the more we get out. Therefore, we can just project revenues, for example, and user growth into the future and derive a valuation even upon exit on that trajectory. The other thing is, nobody's forcing you to accept the valuation. So there's no rule that says only the VCs can walk away from a deal. As a founder, you may also want to retain a certain liberty and walk away from the deal, especially if you are talking to other parties who are interested in the same investment and are willing to offer more. At the end of the day, it's a marketplace where supply and demand meet, where the best offer, the most compelling offer will prevail.
Thank you so much. In the next episode, we are going to talk about what happens once a founder gets an investment, what reporting looks like, and how you, as a founder, can leverage your VC relationship. I'll see you in the next podcast. I'll hear you in the next podcast. See you there.